Hello, tradeologists. Well, we are really getting into something interesting here, and I think you're really going to like this strategy. It's very exciting. It's something that should come naturally to you after going through the first 9 modules here. And you should really have a good understanding, at least what you're looking at, because this is, our profit graph. This is the graph that we use all the time when we're doing positive theta trades. This is a positive theta trade that I have on right now on the QQQs, and as you can see, we're positive theta about 42.78. That means that, of course, we collect money every single day that this position is on, because our options will expire and option premiums will decrease and decay over time until expiration, as long as they're out of the money or even at the money. So what I have here is a September. Basically, it's an iron condor. But what is an iron condor? An iron condor is really nothing more than a bunch of vertical spreads for credits. You're basically doing vertical credit spreads. And as you can tell right now, that it's just slightly, our current price is right here. It's just slightly off to the center. Of course, we'd like to be at the center, but it isn't. It's slightly off to the center. Now, in times previous, in the previous modules, I've talked about adjusting, and many people have written to me and asked me about adjusting because sometimes they get it, sometimes they don't quite get it. I say that adjustments are probably the most important thing that you can learn in this course, because once you put a position on like this, what happens if it moves against you? Well, remember what we talked about in gamma scalping. In gamma scalping, basically what we did was we purchased a straddle and then we traded the stock around that. Ideally, what we want to have happen is to keep the prices basically in the center of our profit graph, or at least adjust it so that we can continue to have a nice profit area here before expiration. But here's the issue that you have when you do any kind of vertical spread, or condors, or even if you're doing calendars or something like that. And that is that you can adjust it maybe once, but remember I told you try not to overtrade as much as you can. In other words, you might make one adjustment on a position 30 to 40 days before expiration, but after that you really can't do any more adjustments because the premium just isn't there. Calendars are great for adjustments because you can always do an at the money calendar, and you've got some premium there at the money and right up until expiration. But for the most part, it's very difficult to do adjustments more than one time. And normally, if the price goes against you immediately after putting on a theta trade like this, a positive theta trade in which you're doing calendars or double calendars, or vertical spreads of any kind, that's about all you're going to get a chance to do. If it goes against you immediately, you get to adjust. But as you get closer to expiration, it's almost impossible to adjust. That's why this is kind of interesting. I call it theta scalping. It's just like gamma scalping, only it's a little different, but you're basically doing the same kind of strategy. You're going to be taking a look at your deltas. Just like with gamma scalping, you're going to be taking a look at your deltas in order to become delta neutral. As I mentioned, but it's with a purpose, becoming delta neutral with a purpose, and that is to keep the maximum amount of profit potential going in your trade as much as you can. Now, you can see that the price is right here right now. In order for us to get delta neutral, what do we have to do? Well, if we're negative 248 deltas, that means that we are short 248 shares of stock. In order to neutralize that to zero, what would we have to do? Well, one thing that we can do is go into our trade tab here, and we can try to pick up some deltas. So if we go back here, we take a look at this, we need to pick up 248 deltas. How can we pick up 248 deltas? Without cutting into our theta, we don't want to cut into our theta here, but we want to neutralize our deltas. Okay, we're slightly negative Vega too, so if if we're short Vega, so if Vega goes down, we make money. If Vega goes up, which usually means a dropping stock market, that means that we're going to lose a little bit of money. But I'm not too worried about the Vega at this point. These are September options, and the current date is August 7th. So I'm not worried about Vega too much. I want to keep my Theta. Obviously, this is how we make the money. Make money in this trade is we keep Theta as high as possible. But what we want to do is we want to neutralize our deltas. We want to get back to the center of this graph somehow, where most of the money is made in this trade. So there's a number of things that we can do to neutralize our delta. If we go over to the trade tab here, we can take a look now we've got these positions on in September, but there's nothing to say that we can't use August options, which still have 8 days left of expiration, in order to neutralize our delta. The only problem with utilizing August expiration options with a position that is going to expire in September is that we may not be able to find the deltas that we need. Now, we need 250 deltas. Well, if we wanted 250 deltas, we could always buy 3 of the August 44 calls, because they have a delta of 85, and if we bought 3 of those, 3 times 85 is about 240. Let's try that. Let's go over here and select, we're going to buy 3 of those. Let's go here and analyze this as a duplicate trade to see what it does to our graph. Well, it does get us back into a neutral delta position, doesn't it? Because we only have 11, we're 11.54 deltas. We were, let me uncheck this, at negative 248 deltas. So buying 3 of the 44 calls with an 85 delta does put us back into a delta neutral position. But what does it also do? Well, number one, it severely restricts the amount of money that we can make. Let's take a look at the green line, which is our expiration line. At expiration, we're going to make $3,440 right at the peak. If we buy the August 44 calls, how much can we make if we keep this to expiration? Well, actually, to the expiration of that call, only $404. It severely cuts into our Theta, doesn't it? Let's do that again. Take a look at the Theta. It's 3278. Buying those 3 calls puts us to delta neutral, but it also cuts into our Theta quite a bit and also reduces our profit graph. So it's an option, and we can do that. Let's take a look at another option. One of the more popular ideas for adjustments is to buy a calendar, which is a current at the money calendar. And that's a way that we're talking about doing adjustments in the earlier part of the course, and talking about just raising the graph in case this does start to move up. Put a calendar right at where the price may tend to go, like at the 47 strike price. So let's go over here and let's do a calendar at the 47 strike price, and we'll go ahead and analyze that. And I think we're probably going to need more than one. And that does somewhat, helps lengthen the top of the curve here, because it's the green line that we're interested in. That's how the maximum amount of money that we can actually make. So this really does restrict the amount of money that we can actually make in this trade right up to expiration with, adjustments of a calendar. I mean, we'd have to do extraordinary amounts of calendars in order to get back to any type of level that we previously had. I mean, previously we had, this. Plus, we could always do, let's do September There we go. Let's see what that does. Now that's a little bit better, but we still have to do quite a few calendars, don't we? And look what happens immediately. I mean, once we put this calendar on, oops, I just got to do this. Okay, there we go. Once we put this calendar on, you know, it does help us adjust, and that is one way of doing it. You can do calendars. I think they're a little bit better than buying the actual options itself. Let's do one other thing just in contrast. And it does add to your actual graph, but only at the center. If we do the 48, now what it does is it extends it out. So there's plenty of room here to do calendars. You can add calendars, but look at how many we have to do. We have to do 16 calendars in order to get to $3,300 in maximum profit. If we take that off again, let me just remind you that we had a $3,400 profit without the calendar. Yes, we can add the calendar and extend our break even to the upside, but look what happens to our profit. We lose money. We lose a couple $100 on our maximum profit. In addition, look at the transaction costs. The transaction cost for buying 16 calendars, okay, let's say we wanted to keep the exact same amount of money that we had in the previous trade. Our maximum profit was $34.40. If we add the calendar, we're at $33.51 right at the peak here. That's our maximum profit at that peak. Well, in order to get back up to $34.40, we'd have to add, I mean, over this, and then we'd have to be at this particular peak. We'd have to add 27 calendars at a cost of $1.50 per calendar times. Now we've got 27 of the Octobers, we got 27 of the Septembers. So we've got 54 contracts. That's $81 in commissions just to put on those on that calendar. Okay? Well, this is what Theta scalping is all about, is extending our break even, bringing us back to delta neutral. It did help our delta, didn't it? But it didn't put us back to delta neutral. You see that? Even though we added 27 calendars, it did help our delta, but it didn't bring us back to delta neutral, and it reduced our profit potential on the trade. Now this is the way we've been learning how to do it, is by adjusting using calendars. How many calendars would we have to do to get to delta neutral, or approximately delta neutral? We'd have to do 45 calendars to get to delta neutral. And that's one of the reasons why I told you guys to trade small. Because when you're doing one or two contracts, when you put a position on for the very first time, and you do one or two contracts, it's easy to adjust, because you can adjust by putting on 3 or 4 contracts. And you don't lose too much. You actually make a little bit more money when you add calendars. And you can adjust using calendars. And I just showed you that you can adjust using calendars, but we'd have to add 45 contracts to get to delta neutral. And that's a lot of contracts. And the reason we had to add 45 contracts to this position in order to get close to delta, and we didn't even get, I mean, yeah, we can get delta neutral, but it also, if you noticed, it restricted the amount of money that we could make on this position. So, but the reason we had to add 45 contracts is because I already have a lot of contracts on. I've got 5 of these, I got 10 of these, I got 5 of this, I got, you know, I'm short 10 of those, I'm short 10 of those, I'm short 5 of those, I got 10 of those, and I got 5 of those. So I've got a lot of contracts here. I've got 10, 20, 30, 40, 50, 60 contracts on already. So we needed 45 contracts just to get to delta neutral and to raise our tent so that we wouldn't get hurt if the price moved against us too much. There is another way.